Hi, everyone, and welcome to the final episode of Just Some Musings for Season 3. In this one, Justin and I recap the year and we go over 6 lessons that we learned from the markets during the year 2025. My recent experience has been that we have some years where we learn absolutely nothing while investing in the markets. An example would be 2017, when the markets seemed to only go up with very, very little volatility. The year 2017, the US markets saw not a single day in which they declined 3%. Or years like 2021 that only taught us to basically add risk, including investing in meme stocks. So this year, I think, was a particularly educational year, and Justin and I will cover a couple of areas that we believe we either learned something new or it reinforced some of our past learnings. I do want to let you know, if you're listening to us right now, audio only, maybe you're driving or shoveling your driveway or working out, I highly recommend watching the video version of this podcast, either on your podcast player if you're using Spotify, or going to my YouTube channel, as a lot of the discussion might not make much sense if you can't see the charts that I'm showing on screen. You can find a link to my YouTube channel by going to nuhs.ca, and on the top left of my website, there's a link to YouTube. Or if you land on my website a day or two after this publishes, I should have a blog post up which will include links to everything, including the video, as well as the actual charts themselves. I want to again thank all of our loyal listeners and viewers. Your likes, shares, subscribes, ratings, reviews on whatever platform you're using are greatly appreciated. I promise you we will be back sometime in 2026 for Season 4. For now, wishing you all a Merry Christmas and all the best in the new year.
I'm using sports as an analogy. I have only known disappointment to a certain extent. Right to the pinnacle, right underneath the pinnacle. Oilers, Stanley Cup final 2 years. The Blue Jays, Game 7, World Series. This past weekend, the Vancouver Whitecaps, we went to go watch it at BP's together as a family. MLS Cup final. Lost to another Florida team in the form of Miami. But yeah, I don't know. So anyway, I'm trying to bring a life lesson from the weekend and how to analogize or bring that into 2025 as a whole, as we go into 2026 in our world of planning and investments. And it's sometimes you don't have to get there. Right? You've achieved a lot by being in second place or getting right close to it, but it's still not quite as satisfying, right? And there's always going to be losers. There's only one winner. You don't have to be that winner.
Well, gold has been winning this year.
Oh, yeah, that shiny thing. Yeah, that's done well. You're right.
But yeah, what I took from this year is, and I mean, I've been doing this for how many years now? I keep tallying up the years. It's getting close to 20, and every year is different. And think back throughout the many years, and there were many lessons learned. I mean, I've always talked about how I kind of got trial by fire right at the beginning of my career, 2008.
Yes,
that was the best time to learn. Actually,
humility.
And the worst time to learn as an investor was when I started investing in late 2002, early 2003. When you had no humility, when basically everything went up and it made you look like a genius. And I was so overconfident. I even put my 1 year return on my resume when I was searching for a job after graduating.
I remember this story. Yeah.
And I mean, that's the same thing that's happening to young people today, is they're becoming very overconfident in investing. We see that a lot. That's one of the things that this year has still not taught us. This is the 3rd year in a row now of pretty much double-digit returns. I don't think we're going to see a crash in the next couple of weeks, knock on wood. But if we finish this year again as the markets are today, it's going to be 3 years in a row of way above average returns. And what are new investors learning about this? Basically, to expect a high rate of return in the 15% range. That the markets only dip every now and then for a few weeks, like they did in April, and yeah, that nothing can go wrong, and we've still got worse to see in the future, and I guess that's one of the lessons we still have to learn. But there were some good lessons this year. I'm wondering what you took away from this year in the markets.
I like talking about management a lot, leadership. there is, interesting, right? Like we just before we started recording this, we made a comment about how the local regional bank in Western Canada got taken over by a larger bank that once was kind of regional in another part of the country. And with that comes change in culture, change in leadership, and change is difficult, right? It's not just difficult for the organizations, it's difficult for the end clients, the customers of said organization, particularly the ones that are being acquired. Um, but it happens. It is. Oh, look at that on the screen there. Yeah, there we
Yeah,
go.
I can show for those of you watching on YouTube or on Spotify video, what I'm talking about. Saw this on my way walking back from my Rotary meeting today.
Mm-hmm.
And this was supposed to be Canadian Western Bank originally when it was planned some years ago. But there is now a sign up on the top of Manulife Place for the first time in 42 years that the building's been around. And it's of a Quebec-based bank. But yeah, there's your
Yeah,
results of M&A, I guess.
but leadership is it's. I mean, it's right there on the top of that building, as you've seen, right? We can talk about and throw out names. Guerrero, McDavid, Drysaitel, McKinnon, whatever. People know who these people are just by their name. That's how synonymous they are with their team, with their organization, right? In the investment world, all I have to say is Warren, right? They'll know which company they're talking about, right? And to a certain extent, there are other CEOs that have been afforded that sort of reputation, usually for all sorts of great reasons because of their leadership, right? Um, Cook, I can keep going on, right? Jamie, right? Even first name, last name. In Canada, Leonard, right? That's a personal favorite of mine, right? Watsa, right? Like they go hand in hand with the organization. And so earlier this year, Berkshire Hathaway, in a somewhat of a surprise, based maybe perhaps in the timing, but not a surprise when you look at the big picture, Warren Buffett finally said, I'm stepping down at the end of this year, right? And everyone's like, whoa, right? And then kind of gave him whatever, like a 10-minute ovation or whatever it was, right? But just today, one of his kind of like lieutenants that was in charge with investing some of that capital that continues to grow within Berkshire Hathaway announced he's leaving. All right, because there was already a successor that was named, the Alberta boy, right? Well, so Coombs is moving over and he's apparently joining JP Morgan, right? And so like leadership changes, and even though this was well telegraphed that Buffett was going to step down, and he finally did, like the market instantly didn't react to it quite well. And if you actually look at Berkshire Hathaway relative to the rest of the market, all things being just throwing it out there, it's underperformed. And there's uncertainty. There's always uncertainty as to what that transition is going to look like. What is that new company going to look like without that figurehead on top, right? When Steve Jobs passed away from Apple, there was no such shortage of conversation about what was going to happen with Apple, right? I bring up Leonard, Constellation Software here in Canada. He stepped down for health reasons, unannounced, like totally just surprised the market, right? Timing of it was unfortunate. There's no good timing for any of that, but instantly they're like, oh, the master behind this capital allocator has all of a sudden stepped away. It's not going to be the same. And so this year, leadership was another lesson that even though you may think that this organization can continue to operate without said figurehead, should they leave, it does cause for a lot of uncertainty. I mean, Zuckerberg and Musk, everyone knows who those names are. They know the companies that those are synonymous with. What happens when one of those guys, one or both of those individuals, leave their company?
Yeah, leadership certainly factors greatly into non-systematic business risk.
Mm-hmm.
While you were talking here, I brought up the chart for
Yeah.
Berkshire Hathaway over the last, I was looking at it longer term. This is the B series. So over 3 years, it averaged about 18% annually, I think. And yeah, just getting back to this year to date, it certainly has not been a nice road since April when Warren Buffett announced that he was stepping down. And I mean, everyone already knew about it, that was going to happen. So yeah, it hasn't been great. I mean, obviously it had a great return in the last 3 years, last 5 years look great. And I mean, everyone was buying this because they liked the types of businesses they owned. And of course, the leadership.
Yeah, since AGM, it's not representative of what the broader S&P 500 has done, even though it used to be one of the key components or the top 10, right, at one point.
Yeah. But yeah, this chart now, I've got the S&P 500 on here in green. In US dollars, a nice 18% year to date. And obviously a couple of those big Mag 7 companies and Berkshire Hathaway as well. And we see obviously Berkshire Hathaway in this brownish color is a bit of a laggard. Amazon has been obviously a laggard here, pulling the average down. But then you've got some phenomenal overtaking here. If you look at this blue line, this is Alphabet, Google. It's up 70% year to date. And we saw it actually was one of the laggards for much of this year. And I think one of the lessons I get from this year is, first of all, how profoundly the news of a particular business can affect its stock price and just the added level of risk you take when you buy an individual company. Just seeing all these lines as opposed to the dark green line here, which is a lot less risky looking, still risky, but not quite as crazy all over the place. Look at this another way as a percent off high. How much did some of these companies drop from their high point? And we see this purple line, which is NVIDIA, down over 35% in April. And even in more recent times is down double digits. You take that risk when there's, some kind of concern about a business, some kind of news, change in leadership, all that kind of stuff. And this year has been no different than every other year.
Every market has leadership in the sense that there's a sector that's pulling it up. Sometimes incumbents are very, very difficult to push out. Some people thought that search was dead because AI was going to start taking over all search, right? And they what was once considered feared, existential threat to their core business, one of the most profitable businesses ever, search. Now they're saying, oh, actually, they're running away with it. They're integrating it better than anybody else. Not only that, they've got the servers, they've got their individual chips that they're developing themselves, and then all of a sudden, flick of a switch, as you can see on the screen right now, it just rocketed, and not just over the course of the year, but within a matter of months.
There will be winners and losers, and right now, with the markets are at a stage, just as maybe the dot-com bubble was back in the 90s, where every company that had some kind of an e-commerce component or .com in their name or whatever, all were considered, darlings, and everybody was piling their money into them. But you have to realize there will be a few winners. It won't be Yahoo, AltaVista, and Google. It's going to be one of them that's going to win the search engine. Microsoft, Corel, they were in the Office application space back then. Or if you look at Netscape, Internet Explorer, they're not both going to win. So we obviously, in hindsight, know who the winners were. All these companies that are in the Mag 7 or whatever that are really impacting the valuation of the S&P 500 a lot in the last couple of years, a lot of them are competing with each other and all have very high market capitalizations because they are in this field, AI, but they can't all win. There will be sort of, I guess, a separation at some point. And that kind of gets back to another lesson for the year. Where are we right now in that analogy? So I was talking about 1995. I remember 1995. To me, that was kind of the dawn of the internet age because that was when my family got internet. That was when my mom, who was a school teacher, she got a directive, I guess, from the county. You need to get connected to the internet at home. We'll pay for it.
AOL disk, CD-ROM.
The story there was my dad went and bought a 28.8 kilobaud modem, and there was some other. It was a local Edmonton OA Nets. Do you remember them?
Oh boy,
they ended up becoming.
Did they do advertisements in the Edmonton Examiner as well? Jeez,
quite possibly. Yeah.
Deep. You're digging deep.
They had a building on 105th Street in Jasper Ave. But anyways, they got taken over by CompuSmart, I think it was. CompuServe was the competitor to AOL. And when we couldn't get the internet to work with OANet, we basically used one of those CompuServe discs in one of my computer gaming magazines. I really went on a massive tangent here, but I'm just kind of really going nostalgic on the internet. That was 1995. That was when the internet was starting to become mainstream. All my friends had internet. And yeah, the internet was a thing. And, at that point, is that kind of where we are right now in this whole AI world? We're just starting to play around with these different tools, ChatGPT and Gemini and Claude and whatever else is out there. And
I
do we
don't
have
know.
is there still a runway? Are we 1995 or are we already at 1999, 2000? And that's why I brought this longer historical
Mm-hmm.
chart up for the S&P 500. This was 1995, and this obviously was the tech bubble, and it
Mm-hmm.
burst, and we saw recovery. And this is something too I want to get at is we know we're in a bubble. Valuations are quite high. I'll show you the Shiller Cape ratio next, and there will be a crash at some point. But if we're back here, will the crash look like this for us? Let me
Yeah.
go logarithmic to make this look a little bit less bad, I think. We did see from 1995, when everybody was getting into the internet, remember, we saw the S&P 500 basically triple. And I'm not predicting that in the slightest, because that would be a lot.
Mm-hmm.
But even though we had this massive bubble bursting in 2000, when the markets bottomed in 2003, they were still quite a bit higher than they were back here. This is a
Yeah.
completely normal phenomenon, and I guarantee it will happen at some point in the future in some form.
The journey was obviously a little bit more roller coastery or dynamic. There's seemingly, when you look at the valuations in past history, it sounds like there still seems to be a ways to go before we actually get to it. And above anything else, above all else, when you look at the commitments, the capital commitments that these leaders in these companies of, the hyperscalers have said between Meta and Amazon and Microsoft, they don't want to lose this race, right? And they've committed to still continue to spend hundreds of billions of dollars into the new year and even further into the future from that. What does that return down the road? We'll find out. But if they've committed to spending $200 billion, or throwing a rough number out there next year, that money's trickling down. It's trickling down to the power producers, to the infrastructure, the maybe not the fiber optics companies. Yeah, fiber optics too, actually. Photonics, cooling companies, electrical grid infrastructure companies, right? Your boring utility companies that are all been thrown into this AI wave too as well, right? So it seems like there's still runway on it.
The one thing that I often hear detractors bring up when it comes to
Mm-hmm.
should you stay long the markets, stay invested, stick with your
Mm-hmm.
strategy, and so forth. There are those who believe that we should time in and out of the markets based on valuations, and one that often gets brought up is the Shiller
Yeah,
Cape ratio. And I don't know if we brought this up in a past episode, but
we
just sort of
certainly alluded to it.
in a nutshell, what this is. So if we know what price earnings ratios are. Those are the stock price divided by the earnings, basically the earnings per share, so that you can have some sort of a ratio of what is a stock worth versus its profits. Typically, what are considered value companies, they trade at cheaper valuations, cheaper price earnings ratios. So you were talking about things like railways, boring utilities. The banks typically are at lower price earnings ratios. These technology names that have a lot of growth in their future, they do often trade on a lot of potential. That's what makes them a little bit riskier. And what we saw in that
Future
previous
cash
chart I
flows.
showed you, how those numbers went up and
Mm-hmm.
down quite a bit with in regard to all those technology names. They trade at much higher valuations because when you're buying them, you're buying future growth. And this chart, so the CAPE, cyclically adjusted price earnings ratio, they look at the stock price divided by a 10-year average of profits. And the reason why there was an interest in looking at that 10-year average is it's meant to smooth out the economic cycles, basically. So over 10 years, you can have one or two recessions in there. So you can look at, what did the markets look like, over 10 years of earnings as opposed to just 1 year, or what a lot of more optimistic investors look at, which is the forward price earnings ratio. What does the current price look like compared to what the companies are forecasting their future earnings to be? So this is kind of the most conservative, backwards looking version of price earnings ratios. If we look at it now, and this is a chart, it goes back to, says January 81. That's not the year I was born. That is January 1881. So that time you had a CAPE ratio of 19 or so, and it went as high as, guess about 25 around the turn of the previous century. Spiked up to, what was that number there? Like in the 30s. That was the 1929 bubble, and then bursting. Of course,
Mm-hmm.
after that, in the Great Depression, it dropped as low as pretty low single digits in the fives. And we saw the tech bubble where it went up to 44. And we've never, it's probably a little bit higher than that. I guess, yeah, about 44. We've never reached levels like that, but we are getting close. One thing that we can gather from this, and I did a whole blog post and video about this a few months ago, is it doesn't tell us anything at all about what the markets will do in the next year. It's hard to really make a decision on, as this is going up, let's say here, 1997, CAPE ratio was into the 30s. I'm sure there were people ringing the alarm bells, and probably some people that took that and decided to go more conservative with their investments. But then they missed out on 3 years in which, again, if I have that long-term chart again here, 1997, they missed a lot of upside.
A lot of upside, yeah.
Where does it end? Where does it come down? We have no idea. A couple of things that are worth noting is, again, mentioning railways and utilities. Back here, if we're talking, or even 1929, 1929 was a time when not a lot of people were doing a lot of fundamental analysis of companies. Benjamin Graham just sort of introduced the subject around that time. And if you had things like railroads and telegraph companies and whatever was around back then reaching price earnings ratios in the high 20s, that is massive overvaluation because these are low growth companies that were trading at really, really high valuations. There was no IBM back then, but today we have an index that is made up of over 50% technologically related growth stocks. And it's not to say all those growth stocks are not all going to the moon, but if we have an index that is much more heavily weighted towards those companies, it really throws this entire number out the window. It's pretty useless in terms of, looking at historical, is this really high number? We don't know because, Nvidia is like 8% of that and Apple is a good chunk of it and so forth.
And also, like, paradigm wise too, the earnings, flat out cash, is in the it's billions and billions of dollars. Again, Google is, for example, it developed one of the most profitable companies or industries ever. Search. This is why they're spending tens of billions of dollars themselves on AI, is because, for the most part, they've been self-funding. Like, they have this cash. And we continue to give these companies all these cash. They are profitable. Well, that we did not certainly see back in the railroad days.
Can you invest in this other than just sort of seeing the dip that we saw in April and using that as a potential buying opportunity? And that's the other thing I wanted to touch on here as well, is just looking at this year. And again, I'm always focusing on the S&P 500 because it is the biggest, most diversified index out there. Mm-hmm. And what we saw this year was, and now we're going from, where previously we were looking at systematic or non-systematic business risk with all those different companies. Now we're looking at systematic risk and what happened to the overall market. Very much this year driven by current events. And it really teaches us as well not to allow those current events, the noise out there, to dictate too much our investment strategy. Yes, what we saw here was basically Trump was elected and he was inaugurated here. Mm-hmm. That was when they really started talking about tariff policy, and they started to saber rattle a bit with Canada and Mexico and so forth, and that affected the markets.
State.
Yep, we saw that big decline here. We saw a recovery as people were thinking more, it's not going to be that bad. The tariffs will be more targeted, less sweeping. And then, of course, here was, we even saw that in the days leading up to right here, which was April 2nd, what they called Liberation Day.
Yeah.
Even that afternoon, before the announcement, before Trump was out there with his big placards and all the countries listed and how much they're going to be tariffed, that day the markets were up. And then, of course, the next day they plummeted. And have a little bit of a zoom in of that in a technical chart here, just how super volatile the markets can get within days. Now, these are candlestick charts, and what they basically show is an opening, a high, a low, and a close. When they're white, those are days the markets went up. So they opened At the base of the candle, they closed at the top of the candle, the wick at the bottom and the wick at the top. Those were the highs and the lows of the day. And red were days when they went down. And we saw here, again, this was April 2nd, a fairly volatile day within the day because the markets did go down, then they recover towards the afternoon. Then the next day after the announcement, and it kind of gives us another lesson too, is you cannot trade on this news because the news happened immediately after the markets closed that day. The markets that day were already thinking things were going to be good. And then within minutes, less than an hour, the futures went down because there was some terrible news, really. And the next day they opened lower. They opened at the top of this candle. They closed at the bottom. And then the next day they opened even lower. They gapped lower. Again, just news. And then you had some crazy days like this day here where I think this was the day when there was some kind of news during the day, right? That Trump was coming off the tariffs. The markets really rallied strongly. And then they plummeted again at the end of the day. So this day, if you look at it, this was a open at 49.53, closed a little bit higher, but it went up as high as 52.46 and as low as 48.35. And then this massive recovery day. And again, there's people out there that will try to trade this, and
they'll try
minute by minute changes throughout each
second
day.
by second.
Algorithmic. By second, really.
You're trying to compete against an algorithm and against hedge funds that have the brainiest of brain power and the most strongest computers out there with direct cellular microwave lines straight to the exchanges. It's not a good environment to compete in.
And if you're day trading, you just can't compete with that. If you're day trading with a discount brokerage account, you can watch the news. You can put CNBC on the TV and think you can have your live quotes. You can have your level 2 quotes and whatever else, but you're just not as fast as those algos. And you're not going to be able to click buy on that discount brokerage account as quickly or sell or whatever. And it really teaches us just how futile that is, that attempt to day trade minute by minute, hour by hour. And when we zoom out again, what did it all matter? Again, this was another one of those years, very much like 2020, I think, where, we had this big drop. This drop represented intraday. Again, if you go to the technical chart and you looked at the bottom of this wick, that was the absolute worst. So that day, or that bottom was at 48.35, the low. I think that was like a 25% off the high drop. It was, of course, only intraday because we closed higher. But yeah, certainly if you just ignore the markets, ignore the noise. And I've kind of taken a different approach on this because ignore the noise seems a little bit too ignorant of what's going on around you, but rather control the noise, understand what matters. That noise that's coming off of the president's social media, that does not have any impact on your retirement 20 years from now. Like when you retire 20 years from now, the value of your investments is not going to be 5%, 10% less because of something that Trump posted on social media way back in 2025. But a lot of people act like they do. And certainly a lot of people, this shows that a lot of people did sell. A lot of people did irreparable harm to their portfolios in this time period. Whereas those who simply looked past it and focused on things that really matter, like their financial plan, were able to see a pretty decent return, even in U.S. equities where all this noise was coming from, where there is still uncertainty to this day.
Yes. I'm going to go back to leadership for a second. And I think I mentioned this before, and I certainly would have mentioned it once he was reelected. But the president of the United States is a very powerful position in a lot of ways, many ways. It's also, typically, at least in most of our lifetime, it's been a source supposedly of stability. It's supposed to be a source of reassurance or leadership. Absolutely, kind of like military leadership, political leadership, whatever, economic leadership. That's not really been the case in the last year, less than a year. And also maybe perhaps going back to his first administration. But what comment I do recall saying is that the United States broadly, or the world economy broadly, in spite of one individual, And this is where I'm getting a little bit, like I said one thing earlier, and I'm slightly changing the tune in that way, right? As well, is that like this organization, the United States of America, and all that it represents, or this organization, Apple or Microsoft, or whatever, and all that it represents, right? Almost sometimes in spite of who's in power, right? If the structure is in place, the institutional controls are in place, you can have situations like you just pulled up on that screen where in 2 months' time, all hell broke loose and people didn't know what the hell was going on, right? We didn't know what the future might have looked like. And yes, is he crazy? Is he actually going to put 40% tariffs or 200% tariffs on China and what have you, right? But somehow it sort of worked itself out, even though tariffs are still a very real thing. It might just end up being 15% for everybody, but it was a very dramatic way of going through and getting to that point, right? USMCA or what have you, even yet to be determined. But in spite of all of that, yeah, you could have kind of closed your eyes and not looked and not done anything and not looked at your phone and not gone to your discount brokerage and traded things for 3 months or so in that time period. And your overall impact would have been almost nil. But sure as heck, that journey in the in-between was pretty chaotic for everyone, right? And so leadership can cause things to occur, right? It caused a major change in the months leading up to it, and then during the course of it, and then systematically, it still seems to have sort of worked out, or they've worked alongside of it. So I'm take it for what it's worth, but one person can make a lot of change, affect a lot of change. But I think if the organization is in place and it's sound, if you follow my thought process.
And really, yeah, there's an extreme level of efficiency of that information. That's what I was kind of getting at with the technical chart as well. But during those days in April where, not only did you have this really quick reaction by the markets intraday and interday, but also like I said, the markets are always taking all the information that is out there, all the publicly known information, and baking it into the prices and basically valuing the future based on that current information. And, we go from a time when people are thinking it's a fairly free world and limited tariffs to suddenly a world where the average tariff is something like 30 to 50%.
The penguins were happy.
Way higher than during the Smoot Hawley days or whatever. Mm-hmm. And I mean, really, it was to the day that day when the markets were down a bunch, they were basically priced as if this was the be all end all and that no change could happen. Obviously, what we saw after that was a lot of change. The taco trade, the Trump always chickens out. And that was largely to blame for some volatility here, some ups and downs. But eventually, the markets kind of came to realize this is the new normal of words, not necessarily a lot of meaning, and not really necessarily, that whatever is stated one day is the rule forever. And getting back to, I guess, a little bit talking about systematic risk. Why do we diversify? Obviously, we don't want to have all our eggs in one bucket. I keep referring to this one index, the S&P 500, again, just because I can pull up a ton of history on it, and it is a fairly diversified index. I know when I'm pulling it up, I'm not really pulling up mostly banks and energy companies as in Canada. But what I'm getting at is, first of all, it's important to not let politics impact this much because, again, politics of one particular country will impact those markets probably, but should those politics impact how we invest? I don't really think so. And if we look at a bigger picture here of, and I know you were probably expecting me to get to this one, Justin, the various markets in the world. And in this case, I'm looking at it in the perspective of a Canadian investor. So I pulled up the various Vanguard ETFs for Canada. Well, first of all, back to the US, that's the purple one here. The blue one here is emerging markets. Finally, a better year, right? And of course, these are in Canadian dollars. So if this is no longer 18%, it's 13 point something because the Canadian dollar went up a bit during the year. Mm-hmm. And then we see some really nice outperformers here. This pink one is the developed Asia, largely Japan. The green one is developed Europe, over 26% year to date. And I was actually surprised when I pulled this up. Canada, although it wasn't always, Europe was doing really good here, mm-hmm. Developed Europe. Canada's pulled into the lead now amongst all these for the year to date. And again, it shows us here why we don't want to have everything in one bucket. Certainly, there's a lot of correlation between these, but we saw for years previous, obviously, look at the last 5 years, it doesn't look quite as good for everyone else other than the US and Canada. Again, pretty surprised Canada's over the last 5 years kept up there pretty well. But
Helps to be
also,
on the same, between the oceans beside the
yeah.
United States.
But also, let's think about like sort of politics and stuff in the news. Well, I mean, largely these other lines have done better because they didn't do so well in the previous years. But now, if we think about, should we base our investing at all on politics? If we think about Canada, Canada actually had politically a pretty tough year as well as economically. Politically, the resignation of our previous prime minister happened fairly unexpectedly, kind of started to become expected around Christmas time last year. And then ultimately happened, I think, in January, right, was when it was made official. And then we got a new prime minister, we had an election, contentious election that could have gone either way, really. Economically, we've been taking a lot of blows from the U.S. from what's been coming out of that Trump administration. You'd think, that would have investors shying away from Canada. But yet here we are. And I mean, in Europe as well, I mean, Europe has all its challenges over the years in terms of keeping up productivity, energy costs, all these different things. You got the war happening not far away. And they obviously did really well this year. And yeah, it's a little bit surprising and also unsurprising. And I mean, it just, again, reaffirms the importance of diversification and not always putting all your eggs into whatever investment happened to do well last year. It was US last year. It was high-tech stocks for the last couple of years. Sure, they did okay, but this won't always be the case. We do need to look at some parts of our portfolio. Maybe a year ago they were down or they just hadn't gone up as much, and actually rebalance into them. And let's throw gold into here. This gives me a monthly price of gold. Obviously, we've seen gold do really, really well. This doesn't even include November, I think. It's just to the end of October. I'm not saying to avoid gold next year, but maybe you had something in your portfolio that benefited a lot from that run up in gold, and it's become a bigger part of your portfolio. Again, it might be time to look at rebalancing things. That's not necessarily going to do the best next year. Although I think it did do the best last year, and I probably would be eating my words if last year I told you to avoid gold. But
archaic shiny metal, it has to stay in the sun. It's helped Canada certainly broadly on the index, right?
Yep.
As a base metal, or not a base metal, but as a material in the material sector. So it is, yes. These are kind of old. These rules, or not these rules, or these lessons, these experiences. They show up. They show up regularly. They show up multiple times, even in 1 year. Wherever you take your window of analysis and say whether it's the spring of 2025 or the decade of the 2020s, or you need to be willing to listen to history or respect what has happened in the past, because underlying fundamentally all of those, the market is based off of people. As much as we talk about algos, those algos are run by people too. As long as the market, it's going to be run by people. And people are emotional. People are affected, whether we talk about it or not, by politics, by economic sentiment, by their own security, right? There's layoffs continuing to occur in Calgary, for example. You can give me some enlightenment about what's happening in Edmonton. But there's a significant amount of layoffs that have occurred or will be continuing to go through into 2026 down here. And but we tend to do the same behavior over and over again. So don't ignore the history. Try to take something out of it, even when we look back in the last 11 and a half months.
So all in all, it's been a particularly educational year in the markets. And I think I would hope that next year is not as much, but that'll be to be seen, I guess. And every year, really, when you're an investor, the more years you have under you, the more wisdom you gain, and you gain that through the fact that things are never always the same. And
what else would we be talking about?
There'd be nothing to talk about. There wouldn't be multiple channels on TV devoted to the subject, right? So yeah,
we'd find something else to complain about. So wonderful. This is probably the last episode for the year. So if that is indeed the case, I hope that you and your family have a wonderful time together. And take a little of
You too.
respite, some downtime,
Yep.
eat a little too much, a little, have an extra drink. Just enjoy the season.
Yeah, and I'm looking forward to the new year. I mean, lots of change happening here. My practice, I'm in the process of trying to hire an associate. I think generally it'll be an interesting year next year. We've got the Olympics coming up, and what are the stats on Olympic years? Do the markets generally do well during Winter Olympic years? When was the last one? 2022? Oh no, I guess not.
Only if the Canadian men's and women's hockey teams win gold medals. Otherwise, it's all downhill. It's all downhill afterwards on that.
Well, I don't know about that, man. 2002 was a bad year. 1998 had also had a challenge. That was long-term capital market. 2002 was, we won, but that was a Enron, WorldCom, and all that stuff. 2006 was an okay year, I think, but it kind of led up to a pretty bad period. 2010 was pretty good, but volatile. 2014 was pretty good. 2018, we had that big drop towards the end of the year. 2022.
How about the Olympics in the 20s, the 1920s?
Yeah. Well, there's 1920. Let's see. But yeah, we'll see where we go from here.
Yeah. World Cup. I'm looking for World Cup. I don't know in what context I'll be able to consume it. But I'm sure I can pull up some interesting statistics about winners, about World Cups and all that. All right. Talk to you in the new year, man.
You too. Any views discussed in this podcast are those of the presenters or any guests and not necessarily those of Canaccord Genuity Corp. Statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views expressed are intended for general circulation only and do not have any regard to the specific investment objectives, financial circumstances, or general needs of any individual, organization, or institution. Investing in equities is not guaranteed, values change frequently, and past performance is not an indicator of future performance. Investors cannot invest directly in an index. Index returns do not reflect any fees, expenses, or sales charges. Please do not hesitate to contact us should you want to know more about anything discussed in this podcast. CG Wealth Management is a division of Canaccord Genuity Corp., member of the Canadian Investor Protection Fund and Canadian Investment Regulatory Organization.